Gold prices are trading range bound between 1,500 and 1,600 this Thursday. So do the charts provide a compelling argument to buy at these levels? Joining me today is Peter Reznicek. He is the head trader of shadowtrader.net. Peter, welcome to the show. I'm happy to have you on.
Nice to be here. Thank you for having me.
So, Peter, you're a technical trader, but the big story in the past week, really the elephant in the room, has been the coronavirus. Are markets fairly valuing any disruption to commerce here?
I think so. I think so for now. I think it's kind of in line with what's expected so far. I think if the market thought it would be worse, it would be worse. Me personally, I don't see the selling is all that heavy, especially even this afternoon. We had a nice reversal back to the upside.
Right.
It just feels like the same old, where you get news headlines that act as catalysts for very short term, taking prices lower, often overnight, but it's very hard for the market to find more committed longer term sellers to actually, take prices lower. So that we continue to see a lot more of the same.
Absolutely. And on the gold front, prices were relatively flat all this week, and then today got some headwinds here. So what do you make of these price patterns that we're seeing in gold?
I like gold. I'm a long-term bull. I have been a long-term bull for some time. The way that I like to look at gold is simply to keep the technicals on as long of a time frame as possible. So for me, I always go out to the monthly and I trade gold contracts and gold ETF, et cetera, and options as well, according to those monthlies. And what I'm seeing here is if you go back about 20 years or so, to the beginning of 2000, it's an amazing uptrend that really has just had a relatively, small or 50% pullback in a beautiful rounded bottom. But this bottom on the monthly has taken years to develop, and we've only started to see the breakout from that in about mid-2019. And that's the rally that's underway now, is really just breaking out of that rounded bottom, pullback type pattern. So I think it looks fantastic here.
Okay, so help us out here with some key levels that we should be looking at for gold at this point.
Sure, certainly. I mean, right now, the first number that we really need to cross is the 1613. There was a spike high there up to about 1613 that happened on early 2020. I believe it was on January 8th. So there was a little bit of a spike high there. So that's really what we need to get through first in order to go higher. But overall, like I was saying, is if you keep your focus on those monthly charts, the month of January, which is obviously where we are right now, is really just the first month of a breakout from a 4-month pattern, right? If you notice, there was gold prices really took off strongly out of the larger pattern in June of last year, right? Had a solid 3 months up, and then we've just gone sideways for 4 months. That's very, very bullish. So the last 4 months or so, or the end of 2019 has really just been consolidating that summer move, and then January now is the first month breaking out of that move. So what I like to tell traders all the time is when you're trading technically and you're looking at a breakout situation, you don't ever want to be a seller in that first month or whatever that first bar is. If you're trading a breakout on a 15-minute chart, those first 15 minutes moving out of the pattern are never a sell because there's always further follow through. So it's the same thing even on the longer time frames. I see this as the first month out of that 4-month pattern and hence should be higher. So I wouldn't be surprised if February is another bullish month, and we just kind of keep this rally moving a bit.
Do you have a longer term forecast for gold? I mean, obviously we've had people on with some pretty uber bullish calls for gold. Where do you stand?
Well, I like to break it up into chunks. I'm not really one to give super long-term forecasts. So for me, the target just has to be the prior all-time high, which was in 2011. I'm just looking for that 1923 level. That would be fine, and then reassess the situation from there.
I think that'd be fine for many people. If we look at the gold-silver ratio now, there's talk that at some point it should normalize. Kind of hard to believe with the levels here, and that silver will even outperform gold. How are you seeing silver?
It's a little bit weaker. I mean, I'm not that much of a silver trader, but I mean, I think it's easy to see the relative weakness. Looking at those same monthly charts, when you look at where the highs in silver now are in relation to prior highs, it's still kind of stuck a bit. If you look at the same 4-month consolidation pattern that I was just talking about, there was a breakout in this month, just like gold, but it actually failed. It's fallen back into range, right? We broke out of that that silver pattern those 4 months at about $18 an ounce. We went as high this month as just over 17, about 17 and a quarter. But look where we are now. We've come right back. 18 and a quarter. I apologize. Right, 1880. Well, went to about 1880, and here we are back at 1780. So it's obviously weaker. I think for investors, for longer term investors in the metals, I think gold is where you want to be. You really want to be with the relative strength leader, and for right now, that's definitely gold.
Peter, do you track the PGMs like platinum, palladium?
A little bit, not as much, and I don't. Me personally, I don't have any opinion as to whether they lead or lag. I have looked at them somewhat in the past, but it's really not my space.
Okay. Finally, let's talk about your approach to technical analysis here and what traders can implement for themselves, because you don't use indicators, right? So tell us about your strategy.
Yeah. So I'm not an indicator person because I've found over time that indicators basically lag the market for one reason. That's one reason I don't like them. And the other reason I really don't like indicators is the fact that they very often flash signals that can remain in an overbought or oversold state for long periods of time. So very often traders who trade off indicators end up being early in the trade, and then the trade goes against them and they see the indicator still flashing that signal. But again, that signal can keep flashing that overbought or oversold, and then they're kind of stuck in the trade. So for me, I just keep it relatively simple. I use candlestick charts. I use basic horizontal and diagonal lines on charts. I'm a huge believer in both trend lines and horizontal resistance, prior highs, prior lows. I definitely bring a lot of relative strength, relative weakness analysis into what I do. And I'm also a student of market profile, which is a little bit more esoteric way of looking at the markets, where you can chart in a different fashion, bringing the element of time in and not just price and volume.
Interesting. Peter, well, it was a pleasure meeting you, and I really appreciate your thoughts today. Thank you for coming on.
Thank you for having me.
Yeah, Peter Reznicek, thank you. And thank you for watching. We will have more for you, so be sure to stay tuned to Kitco.com.